Well, folks, got a few things to react to in this one here today. Nvidia stock popping back big again, right? We'll speak about Nvidia stock in this video here today. Then I got a couple videos I want to react to. I want to react to this one from the biggest bear on Wall Street last year, Mike Wilson. And he finally capitulated earlier this year in 2024 and finally gave in and upped his price targets and whatnot, and he was very, very bearish last year. Obviously, it was a great year in the market. So we're going to hear what he has to say about Nvidia, market risk, the Fed, all those sorts of things. You know, Mike Wilson definitely got a lot of praise in 2022, but let's be very clear, 2023, he got the complete opposite. Pretty clowned on, okay? Carnival CEO, he's speaking about what he's seeing in his business, and I think this is actually very, very important because everybody's looking at all these different businesses and they want to hear, like, what's the up-to-date trend? This is from 1 hour ago. This is a massive cruise operator, right? Certainly not something you have to do. This is a, a spend that people will do if they feel good about themselves, they feel good about going somewhere, right? And so we'll speak about that. We'll speak about that in depth and kind of react to that, hear what he has to say. Appreciate y'all joining me as always. I'll ask in return, smash the like button on this video, that thumbs up button, and make sure you're subscribed. So Nvidia, as I always tell you guys, this stock will, all the dips in this stock will continue to get bought up until what? Until what? Until we see major deceleration in sequential growth. Until that happens, every time this stock dips, it's going to get bought up, as I told you guys yesterday, right? And it's just what's going to keep happening with Nvidia. It's going to dip, then it gets bought up, right? And it's going to be very volatile, as I told you guys yesterday. It's going to be, some big downward moves, and it's going to be big upward moves. And like I said yesterday, don't be surprised if the stock's 150 before you know it. Is it possible in July? It's possible in July it could go to 150. We'll see what happens. But until the business breaks, it's just going to keep going up. Honest is having a great day here today. If I have time to make a main channel video today, I'll speak about Honest along with a bunch of other stocks in that one. But, some pretty exciting news as far as that goes. Outside of that, if we look at big tech here today, clearly the winner chicken dinner is Nvidia, the bunch. And really outside of that, there's not a ton of action here today. I mean, Google's having a decent day, 1.8, and the biggest downward moves IBM at a 1.9%. That's like nothing, right? So there's not a ton of action out there today. Looking at housing stocks getting hit hard. RH down to 213. If that can break 200, I might start a position. Keyword is might. I'm not even guaranteed I would start a position. That's just maybe, because I still don't think that business is in any sort of a good place, and they're very low on cash considering how big the company is. So, but I am keeping an eye on that one. If it breaks 200, might start a position. The thing that scares me about RH is if I start a position at 195, could I see RH going all the way down to $100? Yeah, I could actually. And so that's the scary part is 195 probably is a good price long term, but in the short term, could it go down to a 105 or 110? It's a possibility. If let's say the market deteriorated, S&P went down 15-20%, let's say housing saw even more weakness, and let's say all these housing stocks got hit heavy that had been performing tremendous, like these Toll Brothers type stocks, they've been performing tremendous. I mean, look at Toll Brothers on a 5-year. It's up 214%. If we, take this baby over to let's just call it fourth quarter of 2022, I mean, 174%, you'll be flipping my flapjacks. That's incredible. And so, a lot of these can kind of trade in ETFs together. I mean, if all of a sudden these tolls and these KB Homes and these Century Communities and these sorts of stocks got hit hard, I mean, that would devastate RH stock. You can see that stock under 150. But you would need those stocks to also get hit. You need market to get hit. Those stocks to get hit. It has to be bigger than just RH. RH went from 700 to 200 on the back of, obviously their business model deteriorated massively. But how does it go from 200 to 100? It would need the whole sector of real estate to just get absolutely pummeled. That happens, and then you're talking, right? So, yeah, that's kind of what's going on there. Let's go ahead and react to these videos in Mr. Bear, Mike Wilson.
What's your takeaway from the volatility in Nvidia shares? And to Danny's point, the idea that we have not seen it broaden out to some sort of contagion or real market weakness.
Yeah, well, I think the market is pretty smart. As usual, it's figured out exactly what's going on. We go back to, I think, probably our main narrative, which is probably not consensus yet, which is that this policy mix that we've had is very unusual, right? We had this incredibly strong fiscal policy, which is keeping pressure on the Fed to keep rates higher. We know rates are too high because the yield curve has been inverted. So that is sort of hollowing out or crowding out a good part of the economy and stocks. And so what does the market do? It gravitates to these lifeboats that can actually perform in this very challenging economic environment for most operators. When I say most operators, I'm talking about consumers and corporate. And that's reflected in the data, right? And it's not just the Mag 7, by the way, that's high quality growth. There are some really good high quality growth stocks outside of tech and comm services that have been performing well. And I think you said earlier, this sort of almost like pistons moving around. The VIX is really low and volatility in the S&P 500 is low, but the volatility under the surface is enormous. And so, because it's sort of like the boat that's tilting back and forth. If people are running to different sides of the boat can actually remain fairly stable. And that's what we have going on until there's probably going to be some sort of shock. Maybe it's the elections. And by the way, the elections don't have to be necessarily worried about bad outcome. It's just higher volatility for the broader averages. Like, elections have consequences. And we're seeing that all around the world now. Why is our election going to be any different? When I say consequences, I mean consequences for obviously the economy and for policy, but also consequences for volatility in the marketplace.
So before we get to the elections, and we'll talk more extensively about that in a bit, I do want to talk about the idea of a shock. And you laid out 3 different potential shocks in your recent research, talking about the potential for upside acceleration in inflation. You say nobody's really counting on that, neither do you. Then you talk about some sort of liquidity shock. You talk about the...
So this is what's funny, right? You know, this is a very interesting thing about some of these folks that kind of more like perma bears, which Mike Wilson, listen to the way the man talks, right? He threw in the bearish cards, up S&P 500 price targets massively, had to chase this market. But you really listen to him, does he sound like somebody that's bearish or bullish? Clearly he sounds like somebody that's bearish, right? It's clear as day, and it's not even close. It's not even like hearing what he just talked about there. It's not even like I could say, oh, he's kind of in the middle. And I certainly can't say he's bullish. Every single point he made was leaning toward a bearish angle, a bearish stance, right? So these guys, they can give up on their price targets. They can up their price targets. They can, do this and do that. But at the end of the day, you really listen to these guys talk, and it's very clear in their heart, they're still bearish, right? And in their mind, they're still bearish. It doesn't matter if they put some 5,000 something price target on the S&P. You listen to them talk, they're still bears. And if you still talk like a bear, you are still a bear in my eyes. I don't care what your S&P 500 price target says.
3 auctions and some sort of issue with market functioning. And then you talk about what you see as the most likely, which you just flicked at, which is this idea of growth. Right. And that potentially you could see a real fall off in growth, which was kind of what we heard from Mary Daly. What are the signs that we're getting closer to that? And when do you sort of throw in the towel at that being a near-term kind of reality if we don't see more material weakening?
Well, the market is already leaning in that direction, right? It's saying that growth is probably going to disappoint. By the way, growth has disappointed this year. Most of the economic surprises have come on the downside. That continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because the market's priced for a soft landing, and that is sort of the base case consensus view.
So late cycle, economy he talks about, right? Late stage. So that's just another clearly bearish stance to say late stage.
Downside, that continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because the market's priced for a soft landing, and that is sort of the base case consensus view. That's all well and good. The problem with that is that let's say it happens. Well, where's your there's a lot of upside, which means you got to pick stocks, and so that's what the market's doing. It's doing the best it can in that sort of a setup. So what's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market, right? The labor market, if the labor market breaks down, by the way, that's what the Fed's looking at too. So if we were to see a non-farm payroll number under 100,000, unemployment go to 4.3, 4.4, you better believe the Fed's going to probably cut rates. The market's probably not going to love that initially unless they cut 100. 25 basis points into a real growth slowdown, the market will correct probably 10% on that sort of an announcement.
I was going to say, usually the argument of, stocks can survive is because if they cut, then they get some support. But to your point, it needs to be some cut sort of in size. So if we kind of take a step back and say, all right, Nvidia, clearly there's a lot of valuation here that shouldn't be baked in, that has been multiple expansion. If you just strip that out, does the rest of the market make sense to you, where we are with everything else?
Well, I mean...
Wait, what? Say that again? What?
That's sort of an announcement.
I was going to say, usually the argument of, stocks can survive is because if they cut, then they get some support. But to your point, it needs to be some cut sort of in size. So if we kind of take a step back and say, all right, Nvidia, clearly there's a lot of valuation here that shouldn't be baked in, that has been multiple expansion. If you just that out, does the rest of the market make sense to you, where we are with everything else?
What you just said didn't make any sense. That didn't make any sense.
I mean, like I said earlier, the market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you get any aberration from that, it's going to be a problem. And that's why we wrote about it this week, which is there's these three risks. Could inflation pick up again? Could there be a term premium spike because of the fiscal unsustainability? Or could there be a growth slowdown? Of the three doors, to put it in Monty Hall terms, I'd take door 3 as the highest risk today. Okay, that could change. And this is another lesson from the last year and a half. I mean, how many times have we changed the narrative in the last 18 months? We've gone from hard landing, soft landing, no landing. I mean, it's like, musical chairs. So right now it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in. But we have to be, as macro investors and traders, we have to understand these are the risks.
But there's an irony in it, which you already pointed out, is that underneath the surface, you are getting these big moves in stocks. You talked about going from one side of the boat to the other. The other way it's expressed that stocks is just correlation has broken down between individual stocks. And it's not even just an AI thing, because within sectors, stocks are no longer correlated. Is that a troubling turn? Is it a problem that that's happening? Do we need to completely rethink how we judge sectors and how stocks should be moving together?
Well, it definitely affects the latter part of your comment, meaning that the idea that you're going to trade sectors is out. Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well. Operational efficiency. These are the factors that are working, which is more idiosyncratic. By the way,
so Mike Wilson definitely sounds like somebody that just is looking to kind of follow whatever the trend is at a particular time, right? He talks about, we used to trade sectors, what we made our career on. Now he's talking about basically, we need to play exactly what's been hot, right? Large cap over small cap, right?
Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well.
That's just following the market, to be honest, and not really being a trendsetter, which is, if you're more of a short-term trader, you do have to obviously just follow whatever's hot, whatever the trends are. You can't really make your own lane. As a long-term investor, you can separate and you can kind of be a wolf from the sheep. But when you're a trader, unfortunately, you just kind of got to be a sheep in the whole situation. That's kind of what Mike Wilson obviously is.
Efficiency. These are the factors that are working, which is more idiosyncratic. By the way, the breadth in the market today on a 1-month rolling basis is the lowest we've seen since 1965. Okay, that's even older than me. I mean, that's old. So, I mean,
another interesting thing about Mike Wilson is he went into last year, in 2023, very bearish, but he wasn't the only one. I would say the majority of those Wall Streeters went into last year very, very bearish. The difference is Mike Wilson kept holding out as the market went up more and more last year. More and more of the bears threw in their cards. Mike Wilson was one of the last ones to fold his hand, essentially, and then he finally did it. So that's important to kind of understand that point.
A long time. It doesn't mean it's necessarily the end of the world. We have many examples where breadth got really narrow and then it broadened out again. But typically it requires some sort of a regime shift, right? In other words, if we stay in the soft landing narrative, nothing's going to change. If we move to a higher growth, higher inflation, it's definitely going to shift probably more towards cyclicals. If we go into a growth scare or even recession fear again, that's going to be a rotation into defensiveness. So, we're open for anything because that's our job. We have to be prepared for that.
If we do see a reacceleration of inflation, where would it be coming from?
Well, I think commodities could pick up. I mean, there is this talk of maybe China's going to re-stimulate again, so maybe commodities could seep back into it. I don't think it's going to come from housing. I don't think it's going to come from, this owner equivalent rent. I think that's probably on the downside. Maybe it's in services, services inflation. We saw that in the insurance market, things like that. But we're not looking at a groundswell of inflation like we saw in 2020, 2021, because I don't anticipate the same, impetus from, say, fiscal stimulus really driving the bus in the way that it did in 2021. We need an exogenous shock to get growth to drive kind of a broader inflation. That's why that's sort of number 3 on our list of things that will upset the apple cart right now.
I'm thinking about liquidity right now as your second risk, this idea of treasuries and some of the auctions and what could happen if you get higher yields. But on a broader level, this idea of the lifeboats and the lack of diversity, the sort of lack of breadth in the market, as you say, going back to 1965. At what point does that make the market more fragile? Not less, given the fact that if you have a true downturn, at some point you have to imagine these lifeboats are going to feel it too. It isn't just going to affect everything else that, frankly, in some places have been actually signaling some warning signs about what's ahead.
Sure. And look, all year we've seen one by one some of these lifeboats, sink. I mean, or they at least take on water. So that's normal too, is that, eventually everybody goes to that one boat and then it gets too crowded and it sinks and they jump to the next one. So everything that's going on makes perfect sense in the context of a late cycle economy. That's why we haven't changed our view on that. Like, we don't think it's mid-cycle or this is the beginning of some new expansion. This is classic late cycle behavior, just like 2019 or 2016, 17. I mean, this is exactly what tends to happen. I expect more of the same. And look, once again, I think it's really critical to make this statement again, which is that it's not just tech stocks. Okay, there are plenty of it's like almost like the Nifty 50, right? There's like Nifty 50 stocks that are really people are gravitating to, and they're even more expensive than some of these tech names.
Well, but
Yeah,
I guess
100%.
what I'm trying to get at is, are you going into those names too, or are you steering clear of them because of
Yes, he's going
concentration
into
risk
them.
and the idea that one of them could sink,
He's going
and
into
that
them.
could become really problematic?
He already said
Well,
that.
right now, I mean, we're with everybody else because I think that's what it's a momentum market.
Yes, exactly. He already answered that without you having to. He already told you where he was positioning, and based upon what he said, it sounded like he's just, they're just buying whatever, everybody else is buying, just kind of following each other around. So that's funny.
That one of them could sink, and that could become really problematic.
Well, right now, I mean, we're with everybody else because I think that's what it's a momentum market. Now, I think where we're different than other people is we're saying this isn't stable. To your question earlier, it is fragile. You just have to understand that. And look, these are liquid stocks, so you could, if you're running a portfolio, you don't want to be, doubly overweight some of this stuff, but you need to be leaning in that direction, understanding that you're going to have to move it around in the short term. And if there's a shock, and I think once again that third door is the biggest shock to these Nifty 50 names, meaning a growth scare. A growth scare / recession concern is the one that will take them all down together. That's not a risk today. But that's the one that we're kind of looking at as potential risk in the third and fourth quarter to come back into the marketplace.
Mike, as you're talking about
It's just so funny because it's like Mike Wilson, he's like, chooses to go on this boat, even though this boat's like leaking water all over the place in his view, right? And he's like, our boat's going to sink here. But, I'm going to ride this boat anyways because I'm right here with you guys. It's just like, what? It's like, it's just hilarious. Come on.
different lifeboats and some taking on water, maybe less of them out there. I'm kind of reminded of this conversation I had with Pete Stavros from KKR, just the fact that public markets have been shrinking. Since 95, I think, which was the peak in how many public companies we have, there 40% less. Is there some degree where there's just less lifeboats because there are less companies, that some of the really good companies out there, the OpenAIs of the world, what have you, just aren't public anymore?
Well, I think what's happened is, because of maybe the AI narrative in particular, we've seen people perceive certain boats as lifeboats when in fact they got holes in them. Okay, so that's a mistake. I think there's been a rising tide in many cases that has taken a lot of stocks up, probably incorrectly. So those are the names that we're talking to clients about right now. We're saying, okay, there's sort of the AI winners, and then there's the AI pretenders. Okay, there are many, many companies that are talking about AI. They mention AI, the stock goes up like 2 multiple turns. Like, okay, I mean, those are the things I think you need to be more worried about than buying the true AI winners and saying, well, this actually has a business plan or a potential beneficiary, whether it's an enabler or an adopter. And by the way, just to make it clear, we're more interested in the adopters now than we are the enabler trend that sort of played out. That's gotten priced. So you got to be a little careful. Now it's about who's going to take advantage of this technology to make a better mousetrap, a better business model to win competitive, battles with their competition.
You want to tell us any of those names?
Sure, we've written reports about this. So I mean, if clients can draw them down, we have baskets and everything else. We publish this every week.
Okay, but you didn't actually tell us anything, sir. Come on, man. Alrighty, Carnival, let's hear what's actually going on with their business model. I think this is important here. By the way, pin comment down there today. I'll put a link if you're looking to apply to join my private group, get access to all my premium course curriculums, access to 6- and 7-figure Discord chat, and access to exclusive weekly videos from me.
Steve's back with us. Josh, it's great to have you back. Every quarter, it seems we want to press you on whether you're seeing cracks in pricing or yield or booking curves, and this is not the quarter.
No, it's nice to be here. Thanks. No, it's not. We just were able to report records pretty much across the board, and not only is the records in the actuals for the second quarter, but the bookings we took in during the second quarter for the future are records as well. So wow. We haven't seen that sign of a consumer slowdown. And if anything, we were seeing an acceleration.
Does it?
Yeah, and as I told you guys, this is probably a few months ago now, Carnival's going to benefit no matter what really happens out there. When I've talked to you guys about this, I've explained this is going to play out over the next 10 plus years for Carnival. And although I don't own the stock, it's pretty obvious to see, in my opinion. You have so many baby boomers that have just retired or are going to retire over the coming years, right? They're going to go on a lot of vacations, and it's going to be a lot of cruises. Cruises are very affordable, extremely affordable compared to many other vacations, right? And then on top of that, if you look at how much everything's gone up in price over the last few years, cruises are even a better value proposition than they were prior to Rona, prior to this big inflationary spike we've kind of seen here. So that I think they're going to do a great job attracting families in mass over this next 10, 20 years as well. So between the baby boomers going on a ridiculous amount of cruises for this next 10, 20 years, and then obviously just cruises being so affordable compared to many other vacations, I think the business is going to be in a great spot for the next 10 plus years.
Allow you to put a little more pressure to the upside on pricing.
Well, that's been our goal. That's been our focus. And as you can see in the results, it seems to be working. So the yield increases that we had in the second quarter were a result of a bit of occupancy and pricing, mid-single-digit pricing, which was quite strong that we were anticipating and actually outperformed our expectations. So we did take our full-year guidance up as well, and that is because we expect that pricing momentum to continue.
Some analysts have speculated that, before today, the recent underperformance in shares was in part due to concerns about the health of the European consumer. What are you seeing on that front? It appears the American consumer is quite strong and has a clear appetite to cruise. But what about the European consumer, especially amid all of the political uncertainty in that region?
Yeah, as a matter of fact, our results from the second quarter were driven even more by our European brands than our North American brands. And so their yields year over year were up over 20%, which is pretty remarkable. And as we look out at that booking momentum, so that sense of how do things look in people's eyes for the future, we're seeing that momentum on both sides of the Atlantic. The booking curve is farther out for our European brands than it's been in the last 15 years. So, it pays to have brands that are really dedicated to source markets like Germany, AIDA. It's synonymous.
That EPS beat is very impressive by them. 11 cents adjusted versus 2 cents was expected. And they also beat by $100 million on revenue, too. Nice beats.
With cruising in Germany, P&O Cruises in the UK, it is the dominant player in cruising in the UK, and that serves us very well. Those are great markets, great brands with great consumers.
Josh,
the nice thing with Carnival's business model is they can see really into the future a bit, because most people book these, months in advance, if not a year, 2 years in advance for these cruises. So they can see how demand is looking 6 months from now, 3 months from now, 9 months from now, 12 months from now. So it's definitely very helpful. Another thing that's interesting that's happened in this industry is, because I was an investor in the industry actually prior to Rona, unfortunately, and then Rona happened and kind of devastated the industry there for several years, right? But a lot of those companies had to take on huge debt loads, including Carnival, right? And so that's weakened their balance sheets of these companies. And so that's a bad thing, right? Because then you got to pay more interest, obviously, especially in this higher interest rate environment, and that's no fun. But on the flip side, because of that, it's going to make these very hard for these companies to add a ton more ships, which means they could have some good, I would say, some favorability when it comes to pricing over the coming years. Because when you look at the debt loads of Carnival, Royal Caribbean, all these guys, Norwegian Cruise Lines, these companies all have substantial amounts of debt. And so to go build the next billion-dollar ship isn't super realistic right now. And so likely they'll keep, if you're thinking about supply demand, like I said, it's going to be there for the next 10, 20 years in a massive way, in a bigger way than we've ever seen before. But supply of the ships, at least for the next 5 years, they're not going to increase supply massively in any substantial way because of the debt loads and because we're in a higher interest rate environment. So that's why I'm thinking, although I'm not invested in these companies, I do think they're actually pretty good stocks for the next 5 years.
Investors remember a period where the industry was
10.
looking at real existential questions, and I guess they might be wondering what this current day strength allows you to do in the way of your debt profile, your interest expense, your capital structure.
Yeah, absolutely. We're looking forward to continuing that march back to investment grade metrics. We have been able to pay back billions since our peak, over $6 billion just in the last 12 months. And what we see over the next couple of years with our reduced supply growth in the pipeline, which is intentional, it's going to allow us to take billions of dollars of free cash flow and continue that progress on paying down our debt balance and effectively returning value from debt holders back to equity holders over the next couple of years. And we see a very, very clear path to being able to do that.
Yeah, very well put by the gentleman there. Okay. Alrighty, guys. Hope you enjoyed today's video. Appreciate you all joining me. If you're looking to apply to our private group, that will be the pinned comment down there. You fill out an application, access to all my best courses, access to 6 and 7-figure Discord chat, exclusive weekly videos, access to see the moves I'm making in my $2 million plus Fidelity account week in and week out. Alright, guys. Much love and have a great day.